Hi, everybody, and Happy New Year. Welcome to the first mashup of 2022 with myself, Paul Bratby, and AJ. So we're going to try and schedule these every month now to really to allow people to see what we do, to
Absolutely.
to look for stocks. We're not going to throw thousands of stocks at you, but we are going to combine that technical analysis with options plays, and hopefully people will learn from it. Happy New Year, AJ. Looking very smart, unlike me.
you know, my wife said I was looking a little scraggly, so she made me get cleaned up for the new year. We'll see how long that lasts. With your ability to recognize patterns and then with the options being able to utilize all the different, intricacies of them, I think we've got a match made in heaven here.
Absolutely, absolutely. So we're going to get started, and we're going to look at those ones that
What's that
we looked
last
at
one?
in November. We missed December because of Christmas, really. So we're going to look at those, and we're going to go through where they are right now, what happened, and going to go through those four, and then AJ will just quickly breeze through those on if there's any more options plays there, and then we'll look at three new stocks
Yep.
for this mashup. So firstly, MGY took some
Magnolia
heat.
oil. Yep.
Yes, so we took some heat, but one of the things that we talked about last time was framing your charts and understanding this bullish channel that we're in at the moment. And look where it came to test and reject on the wave four. So it printed a new low wave four here, stayed in the zones, and then it's gone. It's pretty close to that fifth wave target zone now. But I would like to if you just make a note there, AJ, I would like to probably look at this fifth wave target zone breaking and testing the upper bound of this channel, probably around about 25, 50, $26 in the future. I'm not one to always start to take profit when we get to those targets, and I'll show you the next example. So VET we talked about, and this wasn't an options play because it was too cheap. There was no liquidity. But this one has gone to the moon. So I'm just going to isolate that wave count there, 2743. And this is a prime example of really not going to town and taking that profit. So we entered this one at 1017. Both AJ and I said, go physical stop with this. It's now at 1564. Okay, this was a big mover. Broke out of the upside of this channel and pretty much had a parabolic move. Really, really liking this now. So for me, this was just a prime example of Elliott Wave. So one of the rules with Elliott Wave is that the third wave is the longest wave of that sequence. It's the impulse wave, and everybody tries to trade that wave. The only way to trade it is initially to trade that fifth wave, but when it goes longer than that original third wave, it reprints. So now what we're looking for is another wave 4 pullback and add to our position. So it's not happened yet because we just formed a new high today. We're at, we just tipped 400% profit times risk there, the way I work out profit anyway. But this, for me, has turned from really a swing trade to being part of my blend investment portfolio, because this has had a real great move. I've taken away my stops and I've moved it to my investment portfolio because now I'm looking to add to this trade. I'm looking to add to this investment, but what I've got to do is wait for this wave 4 to pull back. And most likely it will come and test the top of this channel around about $13. And you see the pullback zones being presented just there right now. So this presents more opportunity, but we have to be patient and wait for that to happen. and measure that pullback. So VET was a fantastic call, and I hope some people actually got it. IGT, this is the one that's still messing around, okay? We set a 29.12 entry and it's at 27.96 today. It's not really moved anywhere, but I suppose when you look at that, those options, I don't know, you was going quite a way out, AJ, there. So really they're not in a great, in a loss-making position right now, but you can have a look at that in a minute. So this is the one that's not really grabbed, but 3 out of 4 isn't bad. Look at GSK. It's made new highs again today. Blimey. I'm just going to isolate that wave count again there. 10580. So again, this is where that fifth wave turns into a third wave because it's gone longer than that original impulse third wave. So we've blown through this target. We had an entry way down here around about $42 coming out on this fifth wave move. And now we're at 46.59. This has been a big move. And again, if you're trading options and you've got, you're still way out in time, you've got a lot of time here, and you're hopefully making some serious money. But if it does have a pullback on a new wave 4 and the criteria is met again, there could be opportunities. And I don't know how you would do this, AJ, and you'll talk about that in a second, is to actually add some more contracts to this, or maybe some different type of contracts to extend this trade in the future. So that's, if you want, AJ, if I go over to you and you talk about those 4 first.
Yep. Well, let's start with MGY. So MGY, like we said, it came back and it pulled back a little bit and kind of made us white knuckle it for a while. But that's not a problem because it stayed within that channel, right? It tested it at that one point, but it continued to just hover across that level of support, and it finally took off. Now, I'm waiting for it to see, like you said, you pointed out 25.50, 26. I was also looking at, I actually was a little bit lower, 24.75. If it goes above those levels, I'm just going to take my profits. And with my leveraged option, that's going to be about 4 times the amount of profit as if I just traded the stock. So that's kind of a nice piece. But if it pulls back before those levels, I had 24.75, you have 25.50 to 26. If it pulls back, I'm going to be looking to sell some February premium. So that means that I'll be taking a near term, that's the February option. I'm going about 3 to 5 weeks out, and I'm going to be selling the at the money option. I'm going to error to the side of out of the money, and that's going to give me a little bit of cost basis reduction or break-even price reduction. And I'll be able to follow that underlying symbol down, and either it's going to get to February 18th, which is when the option expires, and it'll expire worthless. Or if it starts to head back up again, I'll go ahead and buy to close that option and take whatever difference and just, again, reduce my break-even price and let it run, right? So this is a perfect play. This is something we would talk about in my own program on options premium selling. This is a perfect play for selling premium against. Yeah.
Okay.
So as you mentioned on VET, this one did not have enough liquidity to be playing some back month options on. So we were talking about just buying the stock. And yes, it went to the moon. Now, the scoop is there's now an opportunity to get in if it pulls back. And here's where I would use cash covered put strategy. And the reason is I use the cash covered put strategy whenever I want to add underlying symbols to my portfolio in the long term. So what I would do is I would say, okay, here's what I'm willing to pay for the symbol. And I'd go ahead and sell a cash covered put at that strike price. So if I'm willing to pay $14, $13 to add that to my portfolio, that's the cash covered put I would go ahead and sell. Now, if the underlying symbol dips below $13, I'm going to pay $13 for that underlying symbol. and I'm going to get to add that permanently to my portfolio. If it doesn't, I'm just going to collect premiums every 3 to 5 weeks on trying to get that price that I want to get. So I'd pay attention to that pullback that Paul was talking about, and I'd keep selling. Even if I was doing weekly options every 2 weeks, I'd keep selling cash covered puts at the price I want to pick up this symbol at. With respect to IGT, IGT is fine. So IGT, we went ahead and we bought some of those back month calls. So we're leveraged, but they're not going to be expiring for another, I think, 11 months. And so what we're waiting for here is an opportunity to go ahead and sell premium. So we're not sure yet, according to the way I'm watching it, it's kind of just stalled there at the $28 range. But if it starts pulling back below, say, $27.75, I'm going to go ahead and sell some premium the same way that I'm looking to sell premium on MGY in order to just reduce my cost basis, take a little paycheck for now, and allow IGT to regroup and do what it's going to do.
The volume's really dropped off on IGT at the moment.
Yes. And so selling premium actually makes sense. And the other thing that I would probably do is hedge myself with a protective put that I could sell back later. So go about 3 to 6 months out, maybe a protective put at the $25 strike price. By going 3 to 5 months out, I'll be able to recoup my money on that put, either break even or even make a little bit of profit. So the scoop is a lot of folks tell you to hedge with near-term options. That's like just turning your trade into a loss, right? It's called a loss center or a cost center for the economics of your position. If you go to 3 to 5 months out, you can use that protective option as protection. But then if it doesn't need to be used as protection, you can sell it back and even use it as a profit center for the economics of your trade. So we like to make dual purpose of those protective options. Finally, we were talking about GSK,
yeah.
GSK.
Yeah.
Same thing with VET. So this is first of all, we're not going to be selling premium on this. It's shot too far up. What we're looking to do is actually cash in on our position. Now, this was one we were able to do with a leveraged option. And so we're looking at about 3 times the return that we would have gotten if we would have used the underlying symbol, which is really fantastic. But now we were talking about the same sort of pattern showing up that we saw on VET. And so we may want to think about using, again, some cash covered puts if we want to add this symbol to our portfolio, because that's really the only reason why we would use cash covered puts. If we've got the cash to buy the symbol, we pick the price that we want to pay for that underlying symbol, and we just sell those cash covered puts at that strike price. And if they don't go for that price by the time the option expires, then we get to collect the premium. So I could do that over and over until I either exhaust the pattern or get the symbol. And in the whole time, I'm collecting a little bit of income each time. So that's the strategy I would use there. I wouldn't sell premium against this. I would take my profits as soon as it tops, and then I would start selling cash covered puts in order to secure a place in my portfolio for this underlying symbol.
And we've got earnings on that on the 9th of Feb. So you definitely want to be out, even if it's motoring into earnings, you want to be out before then anyway. That could be the catalyst for some profit taking.
And that's definitely something that you got to keep on your radar, is the earnings. If you're in doubt of what's going to happen during the earnings, which should be 80% of the time you are, go to a cash. You could always get back in the next day if nothing happens, right?
If in doubt, get out.
That's right. That's absolutely right.
I do see a 43. We've got a really strong support zone, 43.30 to 43.60 on GSK. So if we do get a pullback, even if that pullback is the catalyst is earnings, we could see some good support there. That was the previous wave 3 at this point here.
Yeah,
we did come back down to test it here. So this would be your target for those options there.
Those cash covered puts. Yeah. Just start selling cash covered puts at the $44 strike price. And like I
Yeah.
said, if it doesn't pull back, then you get to collect the premium. Right now, if I pull up the premium on a near term $44, let's take a look here. I go to February 18th and I go to $44. I mean, that's uh, an easy cents times 100 shares because each option. So that's an easy $40. You know, you get $40 credited to your account, or you pay $44 for the underlying symbol.
That's pretty good.
Actually, you get the $40 no matter what. It's whether or not you get exercised at the $44 price and get to capture the stock.
Right. Okay. Okay, so let's go on to the first of the three, which is FR, First Industrial. I've just got to re-isolate this because the bar numbers are all different. Every stock's been listed differently. 6865. So using the Elliott Wave indicator suite, 6865. Going to re-isolate that because that's the start of this current trend. So we're in a longer term trend anyway. And it doesn't take the brains of a rocket scientist to see that we've had a real good run in 2021. But what I like to do is isolate when we get this pullback against that main trend and it crosses over in the oversold zone there. So that's a sizable pullback. You see, it didn't happen before in July, but it did happen here sort of September, October. And that was the start of this recent push. And that's all I'm interested in right now is this recent push and the pullback, the profit taking. And again, when you're looking at this, what was the catalyst for this? Dividends. Okay, dividends was the catalyst for this profit taking here against that main bullish trend. So all we need to do is make sure when that happens, there's always a catalyst. It could be the CEO with his pants caught down. It could be earnings. It could be,
there's always an event. You're right.
Or, there's a catalyst. This catalyst was dividends, and it pulled back very, very nice. Very, very nice indeed. Found support in this amber zone. 80% probability it's going to go on and hit that target around about top end $69. We've got the EMA clouds there holding as non-linear support. The stochastics crossed over in the oversold zone. Let's just measure this Elliott Wave oscillator very quickly just to make sure, because I am part human, part machine. So when I'm on mission, and the mission is trading, there's a set of rules, and if those rules are broken, I'm not interested in the trade. So between 90 and 140 is good. Stochastics crossed over in the oversold zone, good. Wave 4 pulled back into that pullback zone. Everything is looking good. Sensible entry strategy. The last thing I look at is risk to reward to that target zone. We're talking 1 to 2.5 at the top end there. So very, very good. Again, when we talked it last time, we talked about the start line. Okay, we cannot go long before it breaches $63 because we've got strong support here back in December, which was previous resistance. So this is a zone in price. It's a very thin zone in which decisions have been made. It was resistance, but then it became support. So we would be foolish to actually go long until it broke that resistance. So we're looking at it for it to break $63. It would be outside the 6-4 moving average high here. So we basically all the stars are aligned for a great looking long if it breaks $63. So over to you, AJ.
Yeah. So one of the things, it's funny that you mentioned it, the catalyst, there's always a catalyst, some sort of event. And I've actually been catching a lot of my program participants on this. We always talk about doing at least a cursory look over what the REIT, what the ETF, what the stock, whatever the ticker is. Make sure you're paying attention to even just to read the headlines, not even read the articles about what's going on, because pay attention to dividends, reverse split announcements, earnings announcements, because all of that's going to make a difference for some sort of pop or drop in price. And when you're thinking about options, the extrinsic and the intrinsic value, that's the only thing they have in common, is that they both are influenced by the underlying symbol price move. So underlying symbol price move trumps things like theta decay, trumps things like implied volatility or vega changes. So keep that in mind. You have to know your pattern, and that's why this partnership with Paul is so fantastic. Now, the other thing that has to be factored in when you're looking at options or plays that are options is, besides the underlying symbol price pattern, you have to take the options chain. And one of the things that I noticed when I was looking at FR when you sent this pick over is there's very little activity on the options. So folks need to remember that options, different than stock shares or ETF shares or index shares, options are created by you and I. The framework is set up by the Options Industry Council, right? They set up and they make it where we have standardized contracts that we can trade with each other, such that you could just go in here on your computer and say, I want to buy and sell these things, not even pay attention to the fact that you've actually created a contract with somebody where you're under an obligation and they have a right to do something with the underlying symbol, hence the hence the name derivative, right? So we have the framework, we have the business place, the marketplace to be able to trade these things. But as we look over here at open interest and volume, there's very little options, even at every different strike price. There's been a handful of traders. In other words, there's not a big marketplace for this option to be bought and sold. So because of that, we'd actually just go ahead along with Paul and just trade the symbol itself, because we don't have any plays with the options if there's no marketplace. You don't want to be the only one holding an option, right? Because then when you go to sell it, nobody's going to want to buy it. So that's a good example of one that we would have to, additionally screen a little bit further to make sure that there's activity in the options chain.
Okay, thanks, AJ. So yeah, one of the things we need to look at technically on this as well is there's been a hell of a lot of volume why it's been basing at this support zone. These little dots here are part of what's called the manager. It looks at volume both and compares it to the previous candle, but also looks at average volume. And since we found this wave 4 support, we've had higher than average volume rejections. There was one there on Friday. So this is basing and it's ready to pop, but don't second guess it. Make sure it gets through the start line. An order for this is a stop limit order. So when you put it into your broker, you say to your broker, I want to buy this at 63.03 plus or minus 3 cents or 6 cents or whatever. If this is a $63 stock, it's not really a gappy stock, so you can have a tight stop on there for your stop limit order of 6 cents or something like that, and you should get taken in. Your broker should get you in there. But so that's FR, really good looking stock there. I've just been patiently waiting. Yep. The next one is PLD. So I am going to go again with the Elliott Wave indicator suite. Every stock is its own cycle. Again, look where it pulls back on this in this channel, oversold zone there. That's where I'm going to isolate the start of this current trend. So I'm going to put that at 6,001. So really, this is the last chance saloon, but it's broken these rules down below. And normally, I would walk away from this, but we've got earnings very, very soon. While I'm actually traveling to the UK tomorrow, I'm flying to the UK, and I'll be traveling once I get there. But earnings come out tomorrow. In fact, let me just look to see exactly when they come out.
before market open.
Ooh, yes. So again, this will be a good thing for you as well. But for me, I've got my stop limit order in 157.68. Again, we've had a great wave 4 pullback, come into the amber zone. We're basing and we're waiting for earnings. If it's a good earnings reaction, let's see what happened last time. We had a good earnings reaction. It gapped up and we had an inside day, and then it kept moving. What happened on the previous earnings? Must have been pretty sort of normal, no real surprises, went sideways. Previous earnings to that must have been pretty good, but we had no massive reactions, no massive gaps. So I'm pretty safe to say that the start line for me, 157.68, when I just look back, there's no real massive gaps. So this has got to work. Even if it's got really, really great earnings results, it probably gap, but it won't gap up enough to actually take my trading straight away. So it will get through that start line. Again, when I'm looking at that start line, I'm going reasonably aggressive with this one purely because my Pearson's R on this profit taking pullback is 98%, which is me. This has been so orderly, it's almost military. This wave 4 pullback. 1, 2, 3, 4, 5, 6, 7 candles. Years and years ago, I used to say to people, the perfect wave 4 is between 7 and 10 candles, and a Pearson's R over 90%. This is 7 candles, it's based, and it's 98%. So this is looking good. All we need is the catalyst to get us into this trade, and that's earnings before the markets tomorrow. Target we've got there around about 177.50-ish, AJ. So over to you.
Yeah, what did you say that your target was for entry? 157.
157.68, but $158 doesn't really matter.
Okay. Yeah. I like that. So what's really nice about this particular symbol is we do have plenty of liquidity. And so one of the things that I would do is I would leverage, instead of buying the stock, I would go ahead and instead buy a back month call. Same trigger spot on the underlying symbol price. So the 157, 158, 157.62, something like that. I would use that same trigger, but I would use an option that I can hold on for a while. So I would use an expiration date, probably use the 2023 leap. And then I'd go deep enough in the money. So a lot of folks, that are jumping into options don't understand that options have a lot of different pieces that influence them. And one of the things we can do to optimize the option for underlying symbol price action is we can go deeper in the money, right? By going deep in the money, what that does for us is that actually opens up the underlying symbol price connection, and it diminishes or reduces the amount that, for instance, time passing by is going to have an influence on it, and also on the buying and selling pressures. Remember, people buy and sell these options in mass in order to hedge their positions. And so if there's some uncertainty out in the market, people will start buying the options, driving the price up, and that's going to really influence things. So if we go deep enough in the money, that gets rid of that effect as well. I'm actually looking at the 110 strike price of a call, currently trading around $46. So it's a little under half. I mean, it's a little over half the price. Actually, no, it's about a third of the price. A third of the price of the underlying symbol, but it's going to move dollar for dollar with the underlying symbol. It's going to do that up through January of next year. So we can have that for the long term. And it's just going to be leveraged about 3-to-1. So I'll go ahead on the same target that Paul gave, about 157.60, something like that. I would jump into that January 2023. It's a leap. And I would go with the 110 strike price. And that's going to move just about dollar for dollar with the underlying symbol and not be influenced by all those other things that influence options. And then I'd be watching carefully. again, if I don't get to the target that Paul was talking about, and instead I start to retrace, that's a perfect opportunity to then sell a near-term call. Like we've been talking about some of the trades from November, sell a near-term call to help us create some income out of that pullback. And so I would be looking to do that. I'd either be looking for Paul's exit to just exit out of that back month option and take all the profits and run. Or if I don't make it there and I start to retrace even a little bit, I could sell some premium to offset my cost and just weather the pullback, the range contraction. That's where I'd go.
Okay, fantastic. So the next is target. This is long term. This is on the weekly time frame. So this is mixing up a little bit here. Just want to go through. I bought this on a fifth wave at $109 down here. So this is where it was for me back here in March 2020. I got a really great regression trend channel here, and I basically got in this because even this is an investment for me. It's not a swing trade, but I still use the same criteria to either add to an investment or to start an investment. So this was a perfect wave 4. You look at the Elliott Wave oscillator, the stochastic, the support down at the 89 EMA cloud there, and then we get that fifth wave move. But look at it, just keep going. And during this time, it's very frustrating for an investor to say, when do I buy? When do I buy? When do I get some more? Because you've not got a crystal ball and you can't look right. You don't know where that high is going to be. You're not Mystic Meg. You will not get that high right. But right now, we've had a first attempt. It came back. We formed a double top. And again, a double top technically is within 3% of the price. That is a double top. I don't need to measure it. I know. Now we've pulled back and we've just tipped into this green zone here, which is perfect. Oscillator's good. This is good. This is the time for me to start thinking now that although it's not that far away from these highs, 217 to 268, this is the first opportunity that the behavior has told me that this pullback meets my criteria to add some more target to my blend investment portfolio. Because the fifth wave move to 290 would really, really help with my position. My first position, and I got a crap ton of shares at $109. So no matter where I buy it now, my average price is going to change. But if I've got a nice target at $290, $300, this is going to be fantastic for my longer term investment. But this is the first opportunity I've had since 2020 to actually get some more of this, because I'm very, very disciplined when it comes to even adding to my blend investment portfolio, never mind swing trading, that the rules must be met, and they are met at the moment. Right now, we just have to wait, look for support. Again, I've got a start line, 237.10 is my start line for this. Again, if you're going to go to options on this, you've got to go out at least a year, maybe 18 months, because this thing travels. Yeah. Just look at this initial move that I got in here way back when, we're talking April 2020. Yeah. Almost two years of just straight up movement. So you've got to think, if that's happened before, this could happen again. So if you can't afford the underlying stock and you're going to go options, you're going to think, right, I'm going to go 2 years out here. I've just got to sit on my hands and let it run because this behaves well. Okay, so that's, technically it's a great setup. So AJ, do you want to have a look at that?
Yeah, and so I agree that this is the perfect time if you're going to go long and add it portfolio for the long duration. So again, if you aren't totally set on having the underlying symbol in your portfolio, and you want to but you have the money to do it, and it would be good to do this. You could use that naked put buying strategy that I've been mentioning a couple times this day. But I think that this is a great opportunity, like Paul was hinting at, for doing some leverage, like we talked about. So again, I do exactly like he said. The farthest out option right now is the January 2024 leap. And here's one of those things where I'll give you a little tip. Just take your pocket calculator. I've got a little calculator built into my here. Just take your pocket cap calculator, and on your option chain, take a column of the extrinsic value and divide it into the, and what you're looking for is a ratio of less than 5%. That's how deep in the money you want to go. So for instance, here I am looking at that January 2024. I'll pick the 150 strike price just as a reference. And if I have $7.38 divided by 75.25, $7.38 divided by 75.25, that's about 9%. So ideally, I'd go a little bit deeper. Maybe I'd go as far as this 130. Again, I'm looking for also some open interest, some liquidity out there so that there is a marketplace. Maybe I'd go to the 130. Here's a case where the extrinsic is 3 divided by 90 and 93 cents. So 3 divided by 90.93. This thing is trading at parity. It's at 3.2% extrinsic value. What we're trying to do is minimize extrinsic value compared to the overall price of the option. And we've successfully done that. This thing is going at $90. So either you're going to pay $218 for the stock, or you're going to pay $90 for an option that behaves exactly the same way. That's the safest bet for finding an option that's going to move dollar for dollar with the underlying symbol. Now, a lot of people use this delta column. You don't know how delta is calculated. In fact, every trading platform might calculate it differently. This is based on a pretty complicated options model. The easiest, most solid numbers that you can calculate even on the back of a napkin is extrinsic divided by mark. So I always tell people who say, well, what about a 90 of delta? They picked up some like free ebook that said, make sure you have a delta greater than 90. Listen, just take extrinsic divided by mark, look less than 5%, and you're solid, whereas the delta might give you some false answers there. So that's what I would do there. I like Paul's idea of just a far out in time leveraged option. Maybe get as much as 3 to 1 on your movement there, Paul. And that's what I would do.
Fantastic. I wish I could trade options.
Paul, you've got to tell me a little bit about your indicator package, because I look at all the different things that you're showing.
Yeah.
And I'd love a little bit more about what this, I've got clouds and just being being the amateur technician that I am, I'm just wowed by it. And I really want to understand a little bit more of all the different things that come in your package.
Okay, so let me just go back to Mashup here, and we'll go to, did we do GSK? We'll go to FR, PLD. Okay. I
like PLD a lot.
Let's go back to the daily. So for me, my trading style is all about understanding behavior. So different market conditions give you different behavior. So one of the strategies I trade is Elliott Wave, mainly predominantly for swing trading. And one of the things I look at is we look at sort of linear support and resistance. So these are these green, amber and red zones, and they're fib zones. So traditionally, the behavior of those institutional traders, they will look at that profit taking pullback, and they will put their fib zones on there to try and either feather in or feather out, add to the positions, or to look to go long, shit or bust. Yeah, excuse the language. So that is linear support. But the EMA clouds, I've been using those, and I've had them developed for years. When you're on the daily time frame, 55 is the gray EMA cloud, and 89 is the purple.
The magenta, yeah.
Magenta, yeah. So what you will find is traditional pullbacks on a daily time frame will find support at the 55 and 8 or 89. If it goes any further, this thing's just going to go. It gives you a good idea of how the stock is behaving overall, because the 55 should be above the 89 if it's in a bullish state. It's as simple as that. So you can see this pullback here that tested that that channel. Look how the 89 held there, and then it pushed again. We've just tipped off the 89 again here. Let's just go back in time.
Oh my!
Look, I mean, it's one of those tools that we sell really cheaply, but you must have it on your chart. And this could be for day trading, or swing trading, whatever. I mean, look at FR. Okay, this previous wave 4, 89, it sticks to that 89, comes up. Now we're in this 55. I have these on all my charts, whether it's weekly or daily, they are there, okay? Because they're so strong. And on the daily time frame for stocks, and again, it took some years, but 55 and 89 are the hot snot ones, okay? And then obviously with the Elliott Wave indicator suite, we like to identify those waves. We've got automated target zones. But a thing that we really look at, we go back to PLD, it's about behavior. Let's go to target. No, let's go to VET. I like VET. That was awesome. Let me go back and we just isolate that. So part of the Elliott Wave indicator suite is you need to identify when that current trend started. Yes, there's a longer term trend, but when we see these pullbacks in the oversold zone in the stochastic and it tested that channel, that's the start of this current trend, because it's just broken out. Look, it's broken out of this channel. So if we just isolate that, and that is 2743. So what that does, it gives the software a little bit of a helping hand to say, right, measure from this point, okay? And then when we had this pullback on the wave 4 here, we measured the behavior of this profit taking. So we've got those linear support and resistance zones, the green, amber, the red that we've talked about. We've got the EMA cloud, but then we look at something else. We look at a false breakout stochastic. So what happens on a false breakout is these yellow dots, just because something goes in the overbought zone, it doesn't mean it's going to come out of there and go straight back down again. What happens is if the price action and the momentum keeps going up, the percentage K and percentage D keep crossing. And we call them false breakouts. And that denotes really strong bullish momentum. So when that stochastic finally breaks that and pulls back in the oversold zone, those yellow dots act like an anchor, and the stochastic's like an elastic band. It wants to return to that main bullish momentum. So when that happens on a wave 4, and it's great behavior. But then we look at the oscillator. It's an Elliott Wave oscillator. It's a 535. So it looks at the cross-sectional area of a 5 and a 35 EMA, okay? And it prints it in a histogram. But what we say is during that wave 4 pullback, that should go between 90 and 140% to the highest point on the wave 3. So what we're doing is building a picture of behavior with the linear support, non-linear support, stochastic, and oscillator. So what we're doing is we're using different sort of types of strategies to measure that behavior, because the 5th wave of an Elliott Wave sequence is the highest probability move. But sometimes this target gets smashed through because the momentum just keeps going. And the good thing about this Elliott Wave indicator suite is it relabels it. It's recognized, it's broken that initial rule. And now this current move is a 3rd wave. So what you have to do now is look at these false breakouts at the top. Fantastic. So we know we've got strong bullish momentum. The pullback zones have started to print, but we're way up there. We're way up in the clouds, okay? So what we look for is we've got previous wave 3, and we've got this little support here. So this potentially could be our pullback zone. Put an alert on your chart, okay? We haven't got the highest point on the wave 3 yet for the oscillator, but when we do, you'll see the oscillator start to move down. That means those EMAs, that 5 and the 35, are getting closer, okay? So momentum is dropping, and potentially we're having that pullback. So at that point, when this profile starts to move down, we'll just measure this. We'll put it on the 0 point. We'll go to the highest point in the wave 3, and then we wait. Again, we're on mission. It's like being a sniper. We've recognized that VET is there, but we've got to wait in the grass for weeks. Wait for this to come down, test one of our pullback zones, potentially test this 55, which is just coming up through there now. Make sure the stochastic's good, make sure that's good, then we press go. So we just then have it, we just set alerts on the chart and all that sort of thing. So that's Elliott Wave, and that, you know, that's good for specific types of that fifth wave move. One of the things that I've developed over the years is trying to get in those trend reversals, okay? Because we'd like to get in lower, or we'd like to, when we're investing, we'd like to get in some more. So what I've got, and I'm introducing it for the first time here, but it's been going for quite a long time, is my ex-Brad algo. So you see these little 6-star buys here. That's like a 6-star hotel. That's the highest probability move. So what this algorithm does is look for those potential trend reversals. So, the Elliott Wave is once you've gone and it pulls back, you get in again. Yeah, and that's one strategy. But the ex-Brad algo, for a 6-star buy to form, there's 12 points of control just for it to print that. For a 5-star, 11, and it goes all the way down to 3-star. But the idea with this strategy is you can get in earlier on a move, so potential trend reversals. So if we look at this here, we look at the pandemic pullback here. We had a 6-star sell there, for example, on VET. Okay, this 6-star sell comes in here. We know it's been rejected here. We just put a stop limit order in to break that. Once that's printed, we let it run. Okay, because if it breaks that, this thing's going to tumble, and that's what happened. Okay. We didn't get a 6-star buy here because the criteria wasn't right, but then we got 5 and 6-star sell, and guess what? It came back down again. Now, when we start to get the 6-star buys, it's recognized we're getting a potential trend reversal. So back in January 2021, I wish I'd seen this then, $5.64 was the entry there, and we'd still be in right now because it's not gone out of the channel. We'd be adding to the position here on the 13th of September for this 6-star buy here. We ignore the 6-star sell because we've got lots of support just here on the left. You see how it wasn't broken. Then we have the Elliott Wave pullback. Then we get on the wave 4. So when you're investing or trading in stocks, for me, it's about the ability to add to those positions. Okay. So Elliott Wave is just one particular strategy, and the ex-Brad algo is another strategy. And I've got, people like to trade stochastic MACD crosses, for example. That's another type of strategy. I've developed that and given it some, extra oomph, and it's called the roller coaster, because some stocks go up and down in a range, like a roller coaster. So that stochastic MACD cross in that sort of situation is a great tool to look for those longs and shorts, those shorter term options plays. And that roller coaster is phenomenal for that, especially with stocks. So
what's nice about, just really quick, what's nice when you said on this particular chart that you would ignore that 6-star sell because it was still in the channel. See, that's a perfect opportunity for those of you out there that do have the ability to trade options, that's the perfect opportunity to do a little bit of selling, and you make 10% back, right? You reduce your cost basis, you reduce your break-even price by 10% in that little like 3-week, 4-week period there. So it kind of turbocharges, all the stuff that's Paul's talking about. So that was the first thing that jumped into my eyes, was like, hey, there's an opportunity there to do a slight adjustment, reduce your cost basis, increase your returns by as much as 20-25%.
Absolutely. Yeah. Again, I don't have that opportunity. So we are, I'm pretty, for me, because I've been in this game a long time and have accumulated a good account size, I just buy physical stock.
Right.
And that's, that's what I do. But I can also trade CFDs. Right now, I've not got that many swing trades on. I've probably got, bear with me. So I've got 1, 2, 3, 4, 5, 6 open trades on the swings. Not forget the blend investment. And then I've got 1, 2, 3, 4. No, that's blend investment. 1, 2, 3, 4, 5 orders on. So you can imagine the amount of sort of capital you need for that. So once I get over 10 open trades, I have to switch to a margin type product, and that for me in Europe, that's contracts for difference. Okay,
right.
It's again like what you're saying with those options. You're buying those options at a third of the price or less than the stock. With CFDs, you are doing it 100 times less. And it's a contract. You're not buying the physical stock. And it's almost like in the UK, we had something called spread betting. It's almost like betting on the direction. You say, right, I'm going to buy 10,000 contracts of VET CFDs to go long. So every time it moves 1 cent, you get 10,000 of blah, blah, blah. So it's very highly margined, and it can be quite dangerous. But it doesn't matter what account size you trade. So I wasn't a massive money manager. I had 18 figures. Believe you me, when you've got 26 trades on, you've got no capital left, even with an 18-figure account, because you will always adjusting the size of your trade compared to the, I always risk 1 to 1.5% of the account balance on a trade. So if it goes against me and takes the stop out, I lose 1%.
That's
on
right.
the upside, on a trade like this, I win 4% of the account balance. So
That's
if
right.
you've got a 7-figure account, 4% is huge.
Yes.
So, and if you've got a win rate in the 70s and 80%, so you're only ever losing 1%, but your average win rate is 1.62%, you're always going to be making money. And that's how I've done it for 20 years.
That's exactly right.
That's
that's the portfolio manager's kind of view of things, rather than just somebody who throws a trade on, takes a trade back off, right? If you can invest your total portfolio in all these different positions, have that win ratio of 70%, have the gains be up to 4%, have the losses capped at 1%, that's growing your portfolio, right? A lot of times folks are just interested on putting on one trade and then taking it back off and kind of testing the water with their little toe. And they're never going to see the type of ratios that you're talking about with win to loss if they're not really focusing on being a portfolio manager. It's a mindset.
Well,
you mind
again,
if I
it's
take
about wealth generation, isn't it? Really,
it is.
You've got to think. VET. It started as a swing trade, but I saw the momentum going, so I took the stop off and I moved it to what I call my investment portfolio, because this has got some great momentum. So all of a sudden, that one little trade that was going to last 2 or 3 weeks, now I could be in there for, I don't know,
half a year,
2 years.
Yeah, absolutely. Now, just as a quick plug for myself, if folks are interested, you've seen all these different signals that you can get from Paul's indicator package and from Paul's, guidance. If you're interested in taking it to the next level with the options, I have a workshop that's running every day. It's a pre-recorded webinar, and I'd love to have you join. You'll get a lot out of the workshop. You'll learn how to select some of these options from the signals that you're getting from Paul. You'll go ahead and be able to, pick the right strike prices, pick the right expiration dates. There's a couple of guidelines, rules of thumbs that you can follow, and I reveal it all in that workshop. So you can go check out that workshop. No cost. Just go ahead and jump in, and in about 45 minutes later, you'll be, geared up enough to be dangerous.
And I would definitely advise that, because options, and I'm a clever guy, I've got 2 degrees, and options confuse me. So I would definitely say join that workshop, because there's a lot of confusion, but there's a lot of benefit to options. So you need a guide. You can't do it on your own. For me, I'm too old in the tooth now, but for those that are wanting to trade options, I can't learn anything else. The matter is full. But for those wanting to trade options, I would definitely advise that don't do it alone. Go to AJ and get in this workshop, because there's a lot to learn. And you can't do it by yourself. No trader. I'm okay. Yeah, I've been doing it a long time, but it's still nice to actually bounce some ideas off somebody and
Absolutely.
be guided every now and then. For me, it's different. When I'm on mission, I'm heartless. I've got no emotion, and I've got these rules. If it doesn't meet the rules, I don't trade. I walk away. If it meets the rules, I get in the trade, I put the stop loss on, and I leave it. I don't second guess it. So for me, it's a bit different. There's a lot of people out there that need their hand holding.
That's right.
And I think options trading is one of those ventures where you definitely need it. So please go and join his free workshop. It's definitely worth the while, because, as I said again, options is complicated, but if you are guided the right way, it can be very profitable.
Yeah, and you can also use it just as easily to, reduce your risk exposure if you understand some of the basics.
Absolutely.
So I like this. I like that, we'll be following FR for a symbol trade. We'll be following PLD for a back month option, and Target as well. We'll look for Target for a leveraged option. And, for VET especially, if it does that pullback, I'd be selling those naked puts. We call them cash covered naked puts, trying to lock in that low price. And if I don't get that low price, I get a paycheck instead.
Absolutely. Yeah. I think as well, when we're doing this each month, before you know it, we'll be building a portfolio, and people that keep coming along, because VET, again, we've decided to stay in that. GSK, we've done the same sort of thing, but you think in six months time or something, we might have a little portfolio going here for people. So these people need to keep coming back, keep watching these videos, because there are options plays there, but also we're building some potential. I mean, even with Target, we're 2 years out on this thing.
Yeah,
we'll be mentioning Target every month now. So I will find those 3 or 4 stocks each week, and we'll each month, and we'll start to build a little portfolio.
Yeah, I like it. I like it a lot. Well, do you have any final thoughts, Paul?
Oh, somebody's just asked to overall market health on SPY. Have we got time?
Yeah, I've got a minute or two.
Okay, just going to go to the weekly a second. Look at that. Can you tell I do a bit of work on there? So I just want to look at this current. Well, I can find it. There we go. It's current channel here. Okay, I'm just going to put that on roughly, and then I'm going to zoom in. Okay, so line of best fit with the channel on the top is around about there. We need 2 or 3 more touches. The center line is more important, and I won't see how good that is until I get into the daily. So I think we're good there on the weekly. Let's go to the daily. Right, so we've got a touch down here, multiple touches here on the top, and here and here. That's a great trend line. Okay, that's my starting point for the channel. Center line on the daily, good support here, support. But can you see how that 55? Look at that. Then we break down to test the bottom of this channel, which I just need to adjust slightly now. Just making sure the center line's pretty good. And then we come back up again. And now we're at the 89. We need to extend that a little bit right now. Okay. So what we have now is a really, really strong trend channel. Okay. One of the things we've got, we're last chance saloon on this 89 and at the bottom of the channel.
Yep.
We need to make sure that we frame that chart with some linear support and resistance zones. So we're just going to put those on here right now. Okay, that seems quite fat, but that's very important. We're actually tying in some previous tests of this 89 EMA cloud, plus also the resistance at the channel there. So this is very strong linear support. So 450 or 449 to around about 453. So overall state of the market is that, that if this current bullish trend is to continue, we can break out this channel a little bit, but we can't really get below 449. Okay. If it does, we've got what we would normally term as a normal wave 4 pullback. Okay. Because we've got our zones there. Where are the next support and resistance? I can see a massive one here again. So what I've put in here, look at that 6-star buy on the XBRAD algo here coming up on that channel there. Maybe we should do a session on SPY options as well and things like that, because that would be interesting. And we can delve down how to trade within the channel maybe.
Yes.
With options, with the XBRAD algo, because that is phenomenal. So this, again, look at this test on the upper bound of this channel here. Look at the test on the lower bound of the channel. We need to join that. We need to have this linear support and resistance zone in again, because look where that is. It's in our green zone. So the thing is not to panic if the SPY starts to come down. For me, that correction could come all the way down to 400 and still be a good buy at that point, because we've got more support and resistance here. So this is the big one though. If it breaks 449, we're looking to come and test this sort of level. The middle of that zone is about 425. Okay. There's nothing wrong with that pullback. It's the market shaking out. And the thing is as well, we've got to think about sector rotation as well. So it might be that the Russell really gets on fire, and we've got got institutional traders taking profit on some of their bigger holdings in the S&P 500 and put it into small and spreading that out into smaller stocks in the Russell, or maybe on some smaller Dow stocks. So
absolutely,
ours is not to reason why, but to trade or die. Okay. So we don't try and spend hours to figure out why that's happened on the SPY.
That's right.
It's happened. All we need to do is understand where those next support zones are. If it breaks the 89 and comes below 40, if it breaks this 89 EMA cloud and we break 448, for example, here below this pivot, this thing's going to come down and test this support. Okay, I can't guarantee it 100%, but I'm 98% sure if that happens and we get a close below 448, there's nothing stopping this coming down to this sort of price here. So this is, if you are trading futures, stocks, bonds, anything like that. This is how your SPY chart should look. You need to have a look on the Qs as well. Make sure you've got something similar on the Qs. Look at that sector rotation. Let's just, I'm not going to go do the technical analysis on the Qs because I've got a flight to the UK in less than 12 hours and I've got to sleep yet. Just look at this. I've done some videos on this. Obviously, I've done some work on this with the Qs. The expert algo is fantastic to get those longs there. But right now, look at this. We're testing the bottom of that channel and we've got a wave 4 on our hands. Okay. Just to be aware that this support could hold here. Okay. This is a critical time right now, but we have got support 350. So as part of, looking at market conditions right now, there's no need to panic. I can't find many shorts right now. I'm in one short. Okay, and I'll share that with you right now before we go. Where are we? I'm in one short on JWN on the daily time frame. Okay, that's the only short I've got. I need to re-isolate that, so bear with me a second. 12278. 12278. But this is a 5th wave short. And I've got an institutional scanner that scans for these things, and this is the only decent one I found. So that just shows you we are nowhere near. People are shouting bearish, sell, sell, sell. If I can't find many 5th wave moves for an Elliott Wave short, we are not in a selling mood right now, honestly. All I do is put testers in the water. So all of these other positions that you see, OHI, massive position. I got in at 30.10. We're all the way up there. All the other ones. This is the only short I've got on, but I always like to put testers in the water because if we do get it, I'm going to make some money and I'm going to cover some potential losses on those longs. Okay, that's how I work. I'm really trying to hunt for these shorts, but they're not happening. They're just not there. I did have another one, but it gapped down way below my entry. So I wasn't going to get caught up in trying to catch that on the way down because you don't know when it's going to find support. So overall market condition right now, we're still on that, bullish momentum for me, unless those levels that I talked about are broken. Hopefully that helps for grilled PBJ.
Peanut butter and jelly. Well, that was a good call. Thanks, Paul.
Thank you.
And guys, we're going to be doing this once a month.
Yeah.
And so you should definitely tune in. Maybe we'll figure out a way to keep this portfolio running and give you a way to tune into that. But we're developing this. So if you've got any sort of comments about how we could move forward, if you'd like us to touch on one subject more than other, if you'd like us to include segments in these calls, please let us know in the comments section of whatever platform you're tuning into us on. And we'll make sure that we definitely take inventory of that and include all of your suggestions. And if you have any sort of questions that you didn't get a chance to get answered during this call between Paul and I, please make sure you put those in the comments as well. We will follow up.
Excellent. Thank you.
Paul,
so
we'll get a date on it, but we'll get something in February for sure.
Yeah, absolutely. I've got a trip away to the UK now until the end of January, but while I'm away, we'll sort a date out anyway. First time since COVID hit, I'm going to see my older kids. I've got a nephew that I haven't even met yet. I haven't seen my grandson for 2 years as well, except for through my Oculus Quest 2 when we meet in VR. So I'm very looking forward to going to the UK because I live in the south of Spain. So yeah, we'll definitely sort something out for February and let everybody know.
Very good. All right. Thanks, everybody. Thanks for joining us. Take care.
Thank you, guys. Bye-bye.